Welcome back to the Deep Dive. Today, we are stripping away the noise and getting straight into the machinery of the market.
This is the Talk Tickers edition.
And we are looking at an earnings call that didn't just move the needle, it basically took a sledgehammer to it. We're talking about a ticker that had a very, very rough Wednesday.
That would be Graphic Packaging Holding Company, ticker GPK.
GPK.
And rough is putting it lightly. If you were watching the tape on Wednesday, you saw GPK getting just absolutely dismantled. The stock was down about 9.6% intraday.
Wow.
Slammed right into a fresh 52-week low, trading around, what was it, $13.89.
Yeah, I pulled up the chart right before we started recording. It looks like it just fell off a cliff at the opening bell and kept on tumbling. So our mission today is clear. We are not here to be cheerleaders.
No, by the dip talk?
No, we're here to perform an autopsy. Why did the market react so violently? Because reading the headlines, this feels like a classic kitchen sink quarter to me.
It absolutely fits that profile to a T. You have to look at the context here. There's a new CEO, Robert Riapro.
Right.
He's only been in the job for, what, a month? And this call was the textbook maneuver. The new guy walks in, looks at the books, and just decides to reset expectations. Dramatically lower.
He's clearing the decks for 2026.
Exactly. And the market is choking on just how messy that cleanup is going to be.
It's the old blame the last guy strategy, or at least fix the last guy's problems immediately and very publicly.
Right.
But let's get into the actual numbers that caused all this panic, because on the surface, you look at the revenue for Q4, and it didn't seem like a disaster movie, did it?
No, not at all. The top line was actually pretty stable. Revenue came in at $2.1 billion for the fourth quarter.
Which was a beat, right?
A slight beat, yeah. The street was at $2.03 billion, and it was basically flat year over year. So if you only looked at revenue, you'd have no idea why the stock is down almost 10%.
But then you scroll down to the bottom line, the earnings per share.
And that's where the cracks start to show.
Okay.
This is the first real pain point. Adjusted EPS came in at 29 cents.
29. And the street was expecting, what, 36?
36 cents. That's a 19% miss. And if you look at the GAAP number, the unadjusted one, it was even lower, 24 cents.
A 19% miss is big, sure. But stocks miss earnings all the time without, crashing 10%. There has to be something else here.
You're right. The Q4 miss is just the appetizer. The main course, the thing that really terrified the algos and the analysts, was the guidance. The outlook for full year 2026 was, well, it was shocking.
How bad?
Management is guiding for adjusted EPS of 75 cents to $1.15.
Wait, hold on. Let me just check my notes because that can't be right. Before this call, the consensus estimate it was up around $1.77, wasn't it?
That's correct. So they're guiding almost 50% below where the street thought they would be.
That is a massive disconnect.
Massive. When you guide that far below consensus, you're not just missing targets. You are breaking the models that analysts use to value the company. They also guided revenue for 26 to be between 8.4 and 8.6 billion, and EBIT to be roughly 1.05 to 1.25 billion.
Okay, so let's unpack this. A miss of that magnitude implies one of two things. Either the business is fundamentally broken, or they're doing something very drastic on purpose. Why is the earnings forecast so incredibly low?
And that brings us right to the core of this whole kitchen sink story. The main culprit isn't that people stop buying boxes. It's that Graphic Packaging is holding way too many of them.
An inventory issue.
A huge inventory bloat. Riapro and the new team, they were surprisingly blunt about it on the call. They're sitting on way too much inventory. Right now, it's about 20% of sales.
Which is high for them.
Historically high, yeah.
Yeah.
The new management wants that down to 15 or 16%.
Okay, so they need to clear out the warehouse. Makes sense. But walk me through the mechanics. Why does selling off your existing stuff hurt your earnings? Shouldn't that generate cash?
It does generate cash, and we are definitely going to get to that divergence. It's crucial, but it destroys your margins in the short term. In the paper and packaging industry, the whole game is about something called fixed cost absorption.
All right, break that down for anyone listening who doesn't, run a paper mill.
So think of it this way. These huge paper mills are designed to run 24/7. They're absolute beasts. And you have these massive fixed costs just to keep the lights on and the machines hot.
Right.
When you run at full capacity, you're spreading those costs out over millions and millions of units. So each box is cheap to produce.
Economies of scale.
Exactly. But now Riapro comes in and says, whoa, we have too much inventory. Stop making paper and sell what we've got. So they have to run these production curtailments.
We're deliberately slowing the factories down.
Or shutting down lines entirely. They're trying to burn off about $260 million of inventory.
But the factory still costs money just sitting there.
Precisely. The fixed costs don't go away just because the machine is off. So now you have all those same costs, but you're producing way fewer units. So mathematically, the cost per unit skyrockets.
And your profit margin collapses.
It collapses. That's why the EBITDA and EPS guidance is so low. It's self-inflicted pain to fix the balance sheet.
It's like paying rent on a restaurant, but only opening for lunch on Tuesdays. Your rent didn't go down, so your profit per burger just looks awful.
That's a perfect analogy.
Yeah.
And they said on the call, this isn't going to be spread out evenly. They are taking their medicine right away. The heaviest curtailments are happening right now in Q1 and Q2.
So the first half of this year is going to be brutal.
It's going to be ugly. They even mentioned that Q1 EBITDA is going to take an extra $20 to $30 million hit just from weather on top of all this. So the first half of 2026 is going to look very, very bad on the P&L.
Okay, that explains the bearishness. The market sees a year of terrible earnings, shrinking margins, but usually with a kitchen sink quarter, there's a silver lining, or at least a strategic reason for all the pain. Was there any good news buried in here?
There is. There's a very significant pivot happening. And if you just look at EPS, you miss it completely. And it all revolves around their Waco facility.
Right, Waco, Texas. That's been their massive project for the last few years.
Correct. For years, graphic packaging has been in what you'd call an investment supercycle, building this huge state-of-the-art recycled paperboard plant. The total price tag was enormous, about $1.67 billion.
And what's the status on that? Is it running?
It's effectively done. The project is pretty much complete. But here's the pivot. That spending is over. They are about to hit a CapEx cliff.
Meaning capital expenditures are dropping off.
Drastically. They spent nearly $1 billion last year on capital projects. In 2026, they're guiding CapEx down to about $450 million.
That's a huge cut. That's $500 million that stays in the bank instead of going into concrete and steel.
Exactly. And this is the most bullish part of the bear case, if that makes any sense. Because they stop spending on building, it just mechanically unlocks free cash flow. So even though their earnings, their accounting profit looks terrible because of the inventory stuff, their actual cash generation is about to go way up.
It's that divergence between accounting and cash.
That's the whole story. And in this market, that creates confusion, but it also creates opportunity. The headline EPS number scares everyone away, but the cash flow story is actually getting better.
Before we get too deep into that, I want to touch on the macro picture. I mean, even if they fix their inventory, are people actually buying boxes? What'd they say about the consumer?
It wasn't great. And this is where we have to be realistic. There are real headwinds. Management used the phrase affordability pressure.
Which is just corporate speak for inflation is hurting regular people.
Yes. People are buying less packaged food, less packaged goods. So market volumes are down. If consumers buy fewer boxes of cereal, graphic packaging sells fewer boxes. It's a direct link.
And I noticed they spent some time on bleached board or SBS. That sounds like a tough neighborhood right now.
Oh, it is. Bleach board, that's the high-end white paper board, for cosmetic boxes, pharma packaging. And the industry has a massive overcapacity problem.
Too many factories.
Too many factories making too much of it. And that's just supply and demand 101. You get pricing pressure. Competitors start slashing prices just to keep their mills running. So GPK is feeling that.
They also mentioned something about private label brands.
Yeah, the trade down effect. Consumers are switching from name brands to store brands to save money. Now, GPK says they supply packaging for store brands too, but that churn creates volatility. It's harder to predict.
So messy macro, a self-inflicted inventory correction, and a stock at 52-week lows. Let's talk about the new CEO, Robert Riapro. What's his vibe? Is he a mill guy?
No, and that is a key distinction. The old leadership had that mill mindset, build big plants, focus on tonnage. Riapro comes from P&G and Kimberly-Clark. He's a CPG guy.
A consumer packaged goods guy. So he thinks like the customer.
He thinks like the company's buying the boxes.
Yeah.
His language on the call was totally different. He talked about bringing a CPG mindset to the company. He's not talking about M&A and growth at all costs.
Talking about
Deleveraging and operational efficiency. He's looking at the company like a portfolio of assets.
He mentioned setting up a transformation office, which sounds very corporate.
It does, but it can work. He's talking about using AI and process improvements to cut costs. But the big takeaway from his strategy isn't the buzzwords. It's the shift in capital allocation.
Show me the money. Where's the cash going?
Number one priority, paying down debt. Their net leverage is high, around 3.8 times. That's scary in this rate environment. Riapro was explicit. They plan to pay down about $500 million of debt in 2026.
And they can do that because of that CapEx cut we talked about.
Yes. This is where it all ties together. Despite the terrible earnings guidance, they are guiding for $700 to $800 million in adjusted free cash flow for 2026.
Okay, I want to pause there and circle this in red because this is the number that matters. They just said EPS is going to tank, but they're going to generate up to $800 million in cash.
That is the whole divergence. Earnings look broken because of non-cash charges and the temporary pain of slowing down the factories. But cash flow looks robust because they're liquidating inventory, turning boxes back into cash, and they stopped building Waco. The market is trading on the EPS miss.
But the value might be in that cash flow number.
A value investor might be looking at that 700 plus million and drooling a little bit.
It's a classic value trap versus value play debate. Now, he also dropped a hint about a comprehensive review of the portfolio. What does that mean in plain English?
Optimizing the portfolio usually means one thing: selling things. They're probably going to sell off non-core assets, maybe some smaller businesses that aren't tied into their big mills. The goal is to focus purely on their advantage, which is that Waco and Kalamazoo recycled board loop.
Get rid of anything that isn't making money or isn't strategic.
Exactly. And that brings in more cash to pay down debt even faster.
So the picture is ugly 2026 on the surface, a lot of cleaning up, debt repayment, and a new CEO who is tightening the belt.
That's the summary. It's a transition year. And Wall Street hates transition years. They're messy, they're hard to model, and they require patience.
Hence the sell-off.
Hence the sell-off.
All right, this brings us to my favorite segment. We've looked at the wreckage. Now let's look for the opportunity. This is not financial advice segment.
And we really, really mean it. This is not financial advice. I am not your broker. This is just exploring an outrageous but plausible idea.
Exactly. So if you were a hedge fund analyst pitching a trade based on this disaster of a quarter, what's the pitch?
I'm calling this trade the ugly cash flow arbitrage.
Okay, that's a great name. I'm listening. What's the setup?
The setup is, well, it's pretty simple. The stock's been left for dead, right?
Completely. Down almost 50% over the last year, trading at 52-week lows.
Everyone hates it. The sentiment is peak bearish because the EPS is broken.
It's radioactive.
But as we've been discussing, the cash flow statement is about to explode upward. If they hit the midpoint of their guidance, call it $750 million in free cash flow, with the market cap this battered, the free cash flow yield is getting screamingly high.
So it's cheap on cash, but looks expensive on earnings.
Correct. So here's the trade.
Yeah.
You go long the equity and you go short the near-term calls.
Okay, walk me through that. Why short the calls?
You buy the stock down here in the $13 range. But you know the stock isn't going to skyrocket tomorrow. Why? Because for the next 2 quarters, they're going to report terrible earnings. They told us that.
The headlines will continue to be bad.
They'll be bad. So the stock probably goes sideways or stays volatile. It's not going to $15 next week. So you sell covered calls against your position for Q1 and Q2. You collect that premium income while you wait.
You're getting paid to hold a stock that's currently hated.
And because of the crash, volatility is high, so the option premium should be juicy.
And what's the end game on this trade?
The end game is Q4 2026. By then, the inventory cleanup is done. Factory utilization is back to normal. The debt is $500 million lower. And suddenly, the market looks at 2027 and sees normalized earnings. The stock re-rates higher.
So you've collected premium, you own the equity at the bottom, and you ride the recovery.
It's a hold your nose and buy the cash trade.
I like it. It acknowledges the short-term pain. But what about the risks?
Oh, plenty of risks. If the recession gets way worse and people really stop buying boxes, that cash flow target could evaporate. Or if Riapro finds more skeletons in the closet, you need a strong stomach. You have to be willing to own something everyone else is selling.
Sounds like a trade for the patient investor, not the frantic one.
Absolutely. This is a 12 to 18-month thesis, not a day trade.
So let's wrap this up. Recap for the listeners who might be shell-shocked looking at their portfolio today.
Ugly print. Even worse guidance. The main culprit is a massive inventory correction that's going to crush margins for the first half of 2026. That's the bad news.
And the good news.
CapEx is collapsing, which is great for cash, The Waco plant is online, and the new CEO is cleaning house to pay down debt.
The market reaction was severe, down almost 10%. But you have to ask yourself, is the market looking backward at the inventory mess, or is it looking forward to the cash generation?
That is the multi-million-dollar question, isn't it? The transition from building mills to generating cash is messy. It's never a straight line. But if you believe they can hit that $700 million cash flow target, well, the light at the end of the tunnel is there.
It's just going to be a very bumpy ride through the tunnel first.
It's a very bumpy ride.
Indeed. But that's why we watch. Check your own models. Don't just take our word for it. This has been Talk Tickers. Over and out.